At Insightful Value, we spotlight stocks flying under the radar, and today we've got one that's really intriguing. WhiteHorse Finance is trading near its lows, and the dividend yield looks almost too good to be true. So what's the story? This review is for informational and educational purposes only, not financial advice. If you're into deep value plays and want the straight facts without the noise, hit that like button and subscribe to our channel. WhiteHorse Finance is a business development company, or BDC, that provides debt financing to privately held lower middle market companies in the United States. They primarily invest in first lien senior secured loans, with some exposure to second lien and equity positions. Think of them as a lender that fills the credit gap for businesses too big for microloans but too small for traditional banks. The company's goal is to generate stable income through interest payments while occasionally capturing upside from equity investments. On paper, WhiteHorse has held up its end. The company generates solid net investment income and has consistently paid a high dividend. Right now, the yield is over 12%, which has certainly drawn the attention of income-focused investors. The company's dividend has been relatively stable for several years, typically around 35 to 38 cents per share per quarter, with occasional special dividends. But as always, a high yield often signals perceived risk. And that brings us to the current situation. WhiteHorse stock is trading at a discount to its net asset value. Part of this is due to broader concerns around interest rates, credit quality, and recession fears. As a BDC, WhiteHorse is sensitive to macroeconomic stress. If the companies it lends to start to struggle, there's potential for non-performing loans, which can drag on earnings and hurt dividend coverage. The latest earnings report showed WhiteHorse still generating income above its dividend payout, but the margin of safety has narrowed slightly. Net investment income per share recently came in at around 41 cents, while the dividend remains 37 cents. Leverage is also something to watch. The company is moderately leveraged, which helps enhance returns but also adds risk in a downturn. On the positive side, WhiteHorse's portfolio is diversified across sectors, with no single borrower making up more than a few percent of total investments. Management has also been proactive about rotating out of weaker positions and managing risk. Still, this is a company where performance is tightly linked to credit conditions and economic stability. For investors looking for yield, WhiteHorse offers a compelling income stream with upside potential if credit markets remain stable and the company maintains its dividend. For others, the risks tied to economic cycles and borrower health might be too high. At Insightful Value, we provide clear, jargon-free breakdowns of companies that might not get the headlines but could offer real value. Whether you're an experienced investor or just getting started, we help you see beyond the stock ticker. If you want more deep dives like this, check out insightfulvalue.com for full breakdowns, financials, and value indicators. Don't forget to like this video and subscribe to the channel. And if you want income with an edge, WhiteHorse Finance might be worth your attention.